The commercial real estate bubble could tip the banking sector into an even bigger crisis. At least that's according to Bank of America's latest fund manager survey, which showed that commercial real estate is a growing concern amongst fund managers. Why is this such a big concern? Because banks are holding on to trillions of dollars worth of commercial real estate loans. No big deal, right? That's what banks do. They hold on to loans. The problem is we have offices sitting vacant around the country that are not producing any revenue. But the real reason why you're seeing investors and banks start to get worried about the commercial real estate sector is because these commercial real estate loans are not 30-year fixed rate mortgages. These commercial real estate loans are adjustable rate mortgages. And let me read you directly from what the chief investment officer at Morgan Stanley's wealth division said. More than 50% of the $2.9 trillion in commercial real estate mortgages will need to be renegotiated in the next 24 months when new lending rates are likely to be up by 350 to 450 basis points. I went to go verify this data, and yes, according to the Federal Reserve Bank, there are just around $2.9 trillion worth of commercial real estate loans that are currently outstanding. And now, according to Morgan Stanley, about $1.5 trillion worth of these loans are going to readjust at higher interest rates between now and 2025. Let me get my whiteboard and diagram what this means. Let's assume that a few years ago you bought this commercial building, and this could be an apartment complex, an office building, a retail building, a mixed-use building. You'll see why what the building is matters in just a little bit, but you got this commercial building and you paid $10 million for it. Now, in a lot of these types of commercial buildings, you're going to have to put down 30%, meaning you put down $3 million of your own cash and you borrowed $7 million from the bank. Now, in this instance, you might have bought this property with a 5% cash-on-cash return. In the real estate world, they call it a 5% cap rate, which means that you're getting a 5% return on the value of the building, in this case $10 million, meaning this building makes $500,000 of profit each year without looking at debt. So you bought this $10 million building that's generating $500,000 a year, and you had to finance $7 million. And so you financed the $7 million, maybe you got it at a 3% interest rate because, well, interest rates were super cheap a few years ago, which means that your monthly payments were right around $30,000 for your debt. So your annual debt payments were $360,000, which means that you made $140,000 worth of profit after your debt payments on this $10 million building. Now let's fast forward to now, where we don't know what this building is necessarily worth today. It could be worth more, could be worth less, depending on what industry this building is. But let's assume now that we're not going to look at this. We're not going to look at how much money the building's making, because if it's an office, it might not be making much money at all. But we have to assume now that your debt is going to readjust, because these commercial loans are not 30-year mortgages. They readjust every few years. And what Morgan Stanley is saying is that about half of the $2.9 trillion worth of outstanding commercial debt is going to readjust by the end of 2025. So now you go to the bank and you say, hey bank, I have this building and I have, let's assume that you haven't paid down any debt, just for the purposes of this video, that you have $7 million worth of debt on this building and it's expiring at this 3%. Now, Morgan Stanley says that these mortgage rates are going to readjust 350 to 450 basis points higher, which means 3.5% to 4.5% higher. If we just take the average and we say that the interest rate will adjust 4% higher, that means now it's going to be a 7% loan on your $7 million, which means that your monthly payment is going to jump from about $30,000 a month here to $46,000 a month here, which means that your annual debt payments here after you readjust are going to go from $360,000 a year to $560,000 a year on your debt payments. Which means if you're generating $500,000 in income from this property, you have to pay out of pocket $60,000 to just continue owning this property. Now, this is where it matters. What type of building is it? Because if it's an apartment complex, then sure, maybe you can raise the rents. If it's a retail building, maybe you can raise the rents, unless this retail is around offices where you have restaurants that have been relying on people coming back into work to eat there. But if these restaurants don't have those people going in and eating at the restaurant, they're not going to be able to pay the higher rents. And if it's an office building that's been sitting vacant, good luck trying to raise the rent on a vacant office building. And so this is the big concern, is because you have all these commercial buildings many of them that are office that are sitting vacant. Now in the coming years, you have all these landlords that are going to have this happen. Their payments are going to increase, not because their expenses rose, but because their debt payments rose, because interest rates have gone up and their debts have to readjust. Now, when the debt payments readjust, they're going to have to generate more revenue in order to make up for these higher payments. In some industries, like apartments, you can raise rents. We've seen rents rise in the apartment industry for the last few years significantly. But for the office sector, well, you don't have that same ability. And this is a big concern to a lot of banks because banks are holding on to trillions of dollars worth of loans. And so now if landlords start to become, well, bleeding cash, well, that could push more landlords to become underwater. And if more landlords become underwater, well, then they're not going to be able to continue making their payments. If they don't make the payments, well, that could cause a major crisis in the commercial real estate market. We did a whole deep dive of this in Market Briefs, which is my free financial newsletter, which is why if you have not joined Market Briefs yet, I highly recommend you do so because for one, it's a free way for you to stay up to date on what's happening in the financial markets. Number two, it's very brief. You can read the newsletter in less than 5 minutes every morning. And three, we're going to keep you updated on things like the housing market, the economy, the stock market, the global economy, and everything in between. So if you haven't joined Market Briefs yet, I'll put the link to how you can join for free down in the description below. This is where all eyes are going to where are interest rates going to be over the next couple of years, because there's a couple of different ways that this could play out. On one hand, if the Federal Reserve Bank keeps raising interest rates to bring inflation down, that means 2 years from now, when you see all these commercial real estate loans adjust, and it doesn't start in 2 years, it's going to be happening between now and 2 years from now. But over the next 2 years, if interest rates stay high, that means that all these corporate debts and these commercial real estate debts that come due are going to have to readjust at higher interest rates. And if the landlord is not making enough money, then they're going to be forced to sell. And this could put more supply of commercial real estate on the market. And what happens with demand and supply is that when you increase supply, that could pull down the prices if demand doesn't rise fast enough to meet supply. So if we continue to see higher interest rates, it could force more commercial landlords, commercial property owners to sell their properties because they're not making enough money to continue making their payments. The second side is, well, what if the Federal Reserve Bank pivots? Because there's a lot of people out there who believe that the Federal Reserve Bank is going to change course on interest rates. Last year, the Federal Reserve Bank started raising interest rates and they very quickly ramped up interest rates in order to bring inflation down. And this is where now a lot of people are saying the Federal Reserve Bank has to start cutting interest rates. And when you ask why, the answer is generally because interest rates are too high. People can't afford mortgages at 7%. It's more expensive to buy a car. But that's the whole purpose. And so this is where now, depending on what happens in the economy, there could be a shift by the Federal Reserve Bank. Now, I'm not saying that's what they should do, but the Federal Reserve Bank has made it clear that they may adjust or pivot what they do based off of what's happening in the economy. For example, in the most recent Federal Reserve Bank meeting, they made it very clear that they were going to consider raising interest rates by 0.5%. But then because of the whole Silicon Valley Bank collapse, they decided to scratch that and only raise interest rates by 0.25%. And even that was a debate. They were considering not raising interest rates at all because of what was happening in the banking sector. But then because Jerome Powell and the Treasury Secretary and the FDIC came together to essentially bail out the depositors at banks, the Federal Reserve Bank felt it was okay to continue raising interest rates by 0.25%. What does that tell us? That if we see a nosedive in the economy, that the Federal Reserve Bank could pivot and could start cutting interest rates. How big of a nosedive would have to cause it? Well, that's what nobody knows. But what we do know is that the Federal Reserve Bank now believes, they have publicly stated this in their last meeting, they now believe that the base case is that the United States will enter a recession by the end of 2023. Now, anytime I say that, people say, we've already been in a recession. It's already a recession. Look, by definition, we are not in a recession right now. Now, the average American is already facing a recession, but by definition, we are not in a recession. The United States is not in a recession. So, that being said, the question is, where will it go? Because if interest rates stay high, the cost of debt will rise. And we're just focusing on the real estate market, and not even real estate. We're focusing just on commercial real estate, because commercial real estate works a little bit differently than residential real estate, because residential real estate, you can get a 30-year fixed rate mortgage. So if you get a fixed rate mortgage and you pay off your home over 30 years, it doesn't matter what's going on with interest rates, because you just got to make your monthly payments. Because if interest rates rise or fall, or if property prices rise or fall, it does not matter as long as you have the money to make your payments. With commercial real estate, it's very different. A lot of commercial real estate has a 5-year term, meaning after 5 years, your interest rate is going to readjust. And after those 5 years, you have to go back to the bank and you have to then readjust the mortgage, or you have to sell the property, or you have to refinance. And this is where now we're going to see more than $1 trillion worth of commercial real estate loans come due over the next 24 months. And if now interest rates stay higher and the commercial landlords cannot sell their properties, and you see an increase of supply of commercial real estate in the market, what would that mean? Well, that could be the next domino that a lot of people are worried about, especially with the credit crisis, because let's play the hypotheticals. If I own a $10 million property where I have $7 million worth of loans, now I go to the bank to readjust my loans because my loan has come due, and the bank says, sure, we'll readjust it. But then you look at the numbers and you see that you're going to be having to pay $60,000 a year out of your pocket to just continue the mortgage. And you can't raise the rents fast enough because your property is half vacant because businesses are not coming back into the office. Well, you might try to sell it. Now, you might try to list that property for $10 million because that's what you bought it for. But if a buyer looks at that and they say, well, if I buy this property for $10 million, I'm going to be losing money. So it doesn't make sense for you to buy it at that price. That means then you're going to have to offer a discount and lose money on the property. Maybe you offer it for $8 million. And now if a buyer says $8 million is good enough, then you'll be able to sell it, but you lose $2 million. And this is where now, if you can get a seller and you're okay losing money, then you can get out. But if you start to see a big increase in supply, right, running through the hypotheticals, where more and more landlords then decide to sell their properties because they don't want to continue bleeding that cash, that can increase the supply of commercial real estate for sale over the next 24 months. If that happens, then you would see the prices and valuations of certain commercial real estate fall. Now, of course, not every sector of commercial real estate is the same. Like if you look at the apartment market today, and this can always change, but today the apartment real estate market is on fire. Why? Because rents have risen so much, and the demand for rentals have risen so much over the last few years. Why has the demand for rents and rental properties risen so much? Because buying a home has become so expensive. And so more people are turning towards rentals and nice rentals, and there's a shortage of supply. That's a very different market than if you look at the office market, where businesses have been moving towards work from home or remote lifestyles. Yeah, some businesses are saying come back into the office, come back hybrid, come back full time, but it's nowhere near where we were before the pandemic. So you have all these landlords that are holding onto these office properties, which let's just say is 20 to 50% below occupancy, where now you're trying to renegotiate the leases, and then the business says, we don't want the same amount of property. We don't want the same amount of office. Either we're going to leave, or we're going to reduce our office price that we're paying, or we're going to reduce the amount of property that we're renting from you. So now for the office landlord, unless you can come up with a solution quickly, that can put you into a very deep and tight bind over the next 24 months because, well, we have all this debt that's readjusting. And this is not unique to the commercial real estate market. We're seeing something happen very similar to the corporate market. And when I say corporate, I mean corporate businesses. Because over the last few years, we have been seeing corporations load up on debt. Because in 2020, when interest rates were cut, interest rates fell to their lowest levels ever. So in 2020, we saw corporations load up on debt. And not only were they loading up on debt, they were loading up to the max. We saw the most amount of corporate debt growth ever between 2020, 2021, and even into 2022 because interest rates were so low. Now, the question is, what were corporations doing with that debt? Because if you're taking that debt and you're using it to, say, buy more real estate, invest in more manufacturing, hire more employees, and do more growth, then at least you're investing this debt back into the company. That way you can grow the company faster, make more revenue, and then use the revenue to pay off the debt. And yeah, some corporations did that, but in addition to that, what else did we see? We saw corporations load up on debt. That way they can buy back their own stock. In 2021, we broke a record for corporate stock buybacks. In 2022, we broke a record again for corporate stock buybacks, and we're still on record, on pace today in 2023 to potentially break another record for corporate stock buybacks. So what was going on? Corporations loaded up on debt to buy back their own stock. So you can think of it like going into debt to buy a brand new Gucci wallet. It's a liability. Now, there's nothing wrong with doing stock buybacks. There's a time and place for that. The problem is when you go into debt to buy back your own stock, what does that mean? You're using your future earnings, because debt is borrowing from your future earnings to spend that money today. And then if you use that debt to buy back your own stock, that means you're going into debt. That way you can increase the stock price today, and that means next year you're going to have to pay back that debt with your future earnings. And this debt, again, is not a 30-year fixed rate mortgage. This debt is a variable interest rate mortgage, which means that as commercial real estate loans mature and be readjusted in the next 24 months, you can bet that we're also going to see a lot of corporate debt mature and have to be readjusted over the next 24 months. And so when this corporate debt gets readjusted over the next 24 months, well, you're going to see a lot of corporations then also see their expenses rise. And the problem with that is corporations were using this debt, or some corporations, I should say, not all of them, but some corporations use this debt particularly to buy back their own stock. Buying back your own stock makes the valuation of your company go up because it makes the stock price go up, but it doesn't produce any revenue. A stock buyback is not an income-producing investment. If I went out and I bought real estate as an investment, like a rental property, that's an income-producing investment. If I went out and I bought a business, that's an income-producing investment. If I went out and I invested in new manufacturing, that's an income-producing investment because I can use this new manufacturing plant to sell something to make me money. But if I use my money, if I use my debt to buy a Gucci belt, or if I use my debt to go out and buy back my own stock, it might make my stock valuation and stock price go up, but it doesn't produce any income. So now you have all these corporations that are sitting on their largest corporate debt piles ever, where this corporate debt is going to readjust over the next 24 months. And at the same time, this corporate debt, or a lot of it, a big chunk of it, is not producing any income. So now, this is why interest rates are such an important topic right now, because you have a lot of pressure on the Federal Reserve Bank to stop raising interest rates and to start cutting interest rates. Why? Because you have a lot of influential people, a lot of corporate landlords, a lot of corporations that are telling the Federal Reserve Bank, hey, you better stop raising interest rates and you better start cutting interest rates, because if you leave interest rates high like this, or if you make interest rates higher over the next couple of years, that's going to cause a lot of big pains to the economy. But the problem is we also have inflation. And if inflation does not get under control soon, then that can pose even more problems. This is why the Federal Reserve Bank is, or what the Federal Reserve Bank does now, is so crucial. Because if they pivot and they either stop raising interest rates or they start cutting interest rates before inflation is under control, well, that could make inflation a much bigger problem, and then inflation will continue to hurt the middle class and the poor, because inflation disproportionately hurts the middle class and the poor, and it disproportionately benefits the investors. Why? Because inflation hurts consumers. Who is a consumer? Well, everybody's a consumer. Rich people are consumers, middle class people are consumers, and poor people are consumers. Every single person is a consumer, because anytime you go to the store to buy food, you are a consumer. And when you go to buy food and the price of it goes up because inflation, well, everybody gets hurt by that. However, if the value of your investments rise faster than inflation, if the value of your businesses rise faster than inflation, then inflation also benefits you. Who are those people? Well, that's the investor class and that's the business owner class. That's why inflation disproportionately benefits the wealthy and the wealthy-minded while it hurts everybody else, which is why you need to get financially educated. You need to understand what inflation is. You need to understand how this system works. That way you can benefit from the system instead of just being one of the people that gets hurt by the system. But inflation disproportionately hurts the consumer. And so now, if the Federal Reserve Bank cannot get inflation under control, who is that going to hurt? It's going to hurt the average American. And this is the problem that the Federal Reserve Bank is facing. Because on one hand, inflation is hurting the economy. On the second hand, higher interest rates are hurting the economy. And if the Fed cannot get inflation under control, the average American is going to be the one that's paying the price. Because yeah, you have people saying, oh, the Fed needs to cut rates so I can buy a home. But what most people don't understand is that if inflation does not come down, buying a home is going to be the least of your problems. You're going to have to face things like a currency crisis. You're going to have to face things like, oh my God, your savings are worthless. You're going to have to face things like your company is going under. You're going to have to face things like your salary cannot buy you a loaf of bread. That is a currency crisis. Now, I know I'm being like very extreme when I say these things. And we're very fortunate here in the United States that we are still the world's reserve currency. We are still the world's strongest superpower. We still have the world's military presence. But we have a lot of things happening in the world that are trying to challenge the United States position. And we have a lot of things happening that are trying to challenge the dollar's strength. Like right now, there's a big move for this de-dollarization that's happening around the world, where we're seeing countries around the world that are trying to move away from the dollar. We see the Chinese trying to move away from the dollar. They're trying to work with Saudi Arabia to buy oil, not with the dollar, but with the yuan, their own currency. That way they don't have to deal with the dollar and they can kind of move towards this de-dollarization. We've seen China and Brazil work out their own deal where Brazil and China can trade goods, not with the dollar, but with their own respective currencies. And we're also seeing the BRICS nations, Brazil, Russia, India, China, and South Africa come together and say that they want to create their own new currency. That way they can trade with each other and not have to trade with the dollar. And we're also seeing central banks around the world work to hoard gold at the fastest rate that we've seen in 50 years. That way they can make this new currency backed by precious metals like gold instead of the dollar. Sure, none of this is really an issue yet, but these things are happening right now. And this is where it becomes so important for us to take care of our own money and the Federal Reserve Bank to do the right thing. But for us particularly, because you can't control what the Federal Reserve Bank does. You can't control what the government does. You can't control what a company does, but you can control what you do. And your goal right now should be to take care of yourself financially, to build your own financial wealth. That way you can take care of yourself, your family, and your community, period. Because if you keep relying on everybody else around you to take care of you, if you keep relying on the government to take care of you, if you keep relying on the Federal Reserve Bank to take care of you, you could be in for a world of hurt. And this is where I want you to be financially smart. Build that financial education. That way you can take care of yourself, take care of your family, and take care of your community. What does that mean? Well, right now, that means living below your means. It is American culture to spend, spend, spend. We live in a consumer nation. It just is what it is. I kind of joke that in America, the average person makes $1 to spend $2. But in India, the traditional Indian culture is a save-heavy culture where people work to make $1 so they can spend 20 cents. It's a completely different way of thinking. And what you need to do right now, especially, is learn how to live below your means. That means every time you make $1, you don't spend all of it. You take some of that money and you save it. You take some of that money and you put it aside to invest or invest it automatically. Then, as you start to do that, you then put your money to work. That means investing your money. You look for places to put your money. This could be stocks. This could be real estate. This could be in businesses. This could be your own business idea. This could be you investing in your own financial education, whether it's you buying books, whether it's you buying classes, whether it's you buying some sort of other education to help you either earn more money or invest your money or do something with your money. That way you can build more wealth. But this is the time now for you to understand what's happening, because the reality is there's a lot of media coverage out there that's trying to make this seem very scary. And I get it. Most of the traditional media out there is in the business of trying to sell hype and clicks and emotion. And what I want you to understand is, yeah, all this stuff is happening. It's not going to happen overnight. Things take time to progress. But also, it creates opportunities. And the people who can capitalize on the opportunities are not the ones that are getting emotional, that are getting scared, that are panicking, that are getting greedy. It's the people that can look at what's happening, take a deep breath, and then say, okay, this craziness is happening. What can I do to position myself to take advantage of whatever might be happening in the world? And in order for you to do that, the first thing is you have to be prepared. You need to have cash. Second, you need to have the right financial education, know what it is to invest. And third, when you see an opportunity, be able to capitalize on it. Because if you see an opportunity in the stock market, in the real estate market, in the cryptocurrency market, in the business market, in your own business, you need to have access to money to be able to capitalize on the opportunity. And this is the time right now to be educating yourself and preparing. And then this is where you always get that dissenting opinion where people say, well, what if nothing bad happens? I think the economy is going to grow. I think everything is just fine. Okay, let's go with that. Let's assume that nothing bad happens. Well, if you're prepared and nothing bad happens, you just have a big bank account. Now you can go to Disney World. You can do something else with that money. There's no harm. There's not a single piece of harm in you preparing. Sure, maybe that means you don't get to go to the vacation right now. Maybe that means you don't get to buy the Gucci belt today. Maybe that means you have to sacrifice something today, but there's no real harm in you preparing. But if you don't prepare and nothing bad happens, you're okay. But if you don't prepare and something bad does happen, now you're the one that pays the price, because then if you were able to, if you don't prepare and you lose your job, well, now you're going to be struggling to make your payments. If you don't prepare and you see an opportunity, you won't be able to capitalize on it. That's why preparing and financial education is so important. That way, you're ready when times are good and you're ready when times are bad. And you understand that, guess what? In our economic system, booms and busts happen. This is nothing new. This has been happening for a very long time. Every decade or so, we see some sort of correction or recession or market crash happen. This has happened in the past, and it's going to continue to happen. And now you can either be completely blind to this and ignorant of it and just oblivious to it, or you can understand it, prepare. That way when things happen, you're not surprised, you're not shocked. You're just like, okay, this is a good buying opportunity. And then you can go out and buy investments at a great price, because recessions and market crashes create more millionaires than any other time. Why? Because when you have recessions and market crashes, you can go out and buy good investments at a discounted price. But in order for you to do that, you have to be prepared and financially educated. And that's what my goal here is on YouTube. And of course, we keep you updated on market briefs every single day with what's happening in the financial news, which is why if you haven't joined market briefs yet, I highly recommend you do so. Our last inflation report came in cooler than expected, which naturally has some people excited, claiming the win on the inflation fight, which then poses the next natural question. If inflation is falling, does that still mean that we're going to see a recession? And what's interesting is just a few days after the inflation report